Let's bring in a market voice. Sunil Subramaniam, MD and CEO of Sundaram Mutual Fund, is joining us right now on the show. Sunil, great to have you with us. Give us a sense of how you are reading the market dynamics right now.
So basically, I think that India, despite the slowdown that we faced over the last few quarters, suddenly we're finding that relative to the rest of the world, the market is very attractive for FIIs. The reason for that is that I think the budget was a very strong statement on the government's philosophy of not exceeding the fisc. I think that was very clear. Second is the quality of the expenditure of the government was also more capex rather than revenue. And even the dividend distribution tax removal, I view it as a corporate tax giveaway on top of the 45,000 crores. So I think that quality of our expenditure, I think is good. And I think the Brahmastra of LIC's disinvestment, I think gave a big fillip. And if you actually link the two at the back end, I would link DDT removal to LIC disinvestment. Because if you want FIIs to participate and make the disinvestment a success,
you save LIC, some money from them.
No, LIC is the biggest dividend payer. Yeah. Government is always going to take. So if there was a DDT, it automatically brought down the valuation of LIC in the minds of a foreigner. So I think clearly the DDT tax itself was oriented towards FIIs and FDI. So I think that's where, if you see, that giveaway is clearly a corporate incentive. So to us, that's strengthened the confidence of foreigners that ultimately growth will return in India. And I think a lot of green shoots we are observing right across a lot of industries in terms of pickup in growth. Automobiles, consumer durables, all the news is not as bad as before. And so we retain a very positive view of the market. And if you see, the inflows into mid-cap and small-cap funds have also sharply risen.
January was a good month, I believe.
January was a good month. The actual data will come out, but at our counters, we saw a good 20% growth month over month. So I think the return of the smart investor to, because you're today having mid-cap index at a 11% discount and a small-cap at a 22% discount. So I think the feeling that it can't get worse, and it may take, and that's why you see those indices have delivered 14 to 16% in the last 6 months. So the early movers have got the advantage, have made money. So I think clearly risk is coming back on the table from a market perspective. And if you do study multi-cap funds, you will observe that multi-cap fund managers have also gradually increased their small-cap and mid-cap allocations within their multi-cap portfolio. That is the best way to judge what the market guys are doing. Because in a large cap, SEBI says this much, mid-cap, they say this much. So they will fully use. In the multi-cap, where the flexibility is there, if you track, I'm observing, and our fund also the same, is that we've gradually increased our mid and small cap allocation. So I think that's our read in the market, that it's a good time to invest. That being said, I would see valuations actually creeping up over the next few months. So the other thing which is going to happen is the market is still reading the future. So in that sense, the EPS growth will lag the market price rise. So you will see over the next 3-6 months valuations actually going higher and higher, and a sense of people questioning, saying, is it worth it at this valuation? Is it worth it? So that's a delicious time that's coming up in the next 3 to 6 months that we all would have made money on the market, but you'll be worried whether we should stay in the market.
That valuation dilemma will always be there, because we've seen only a polarized move in last 2 years. You said it's good time to put money into markets. What are the cash levels that your funds are sitting at right now?
No, we are only at 3 to 4% in cash.
And you've been deploying, you said this
We've been steadily deploying. And the funds which are getting money are our large and mid-cap and our multi-cap fund. So luckily for us, there is still a decision to be made at our end on where you put it. If we were getting only into our mid-cap or only into our large cap, then that would straight away go there. And so the opportunity to keep cash also is not there, because once we get in a multi-cap, we can have a broader bucket in which to deploy.
This year actually started off with that theme, maybe broader markets can outperform. And so far, at least till now, we've seen that outperformance. But as you rightly mentioned, still there is a discount compared to the frontline indices. Do you think then all the negatives are priced in now, be it at growth level, macro level? We're done with the budget. And now a lot of people are terming this as a non-event, because the markets have recovered from those lows. The budget actually was good for the FI community as well. From here, from the current levels, do you think if the markets were to rally, the outperformance from the broader markets can continue?
Absolutely, because see, the next big event, according to me, apart from the Delhi elections, is the Trump visit to India and then you'll have the headline of some kind of a trade deal being signed and stuff like that. So I think that will give another boost to the markets, and I do expect that our initial read of the earnings season is that it seems to be fairly decent compared to the previous quarter. From whatever footprint we have seen so far, we are seeing that the banks, for example, have started doing well now across the spectrum of large, mid and small. Early only the large and the larger mid banks were doing well in terms of, so clearly the NPL cycle is turning down. Loans have grown. I think you saw in RBI's report also that consumer loans and auto loans have grown fairly decently. So I think the only risk to the market is that the market's expectation of the pace of the recovery and the actual recovery, I think there's going to be a disconnect, because at the ground it is going to take time. Let's face facts. So that's why I said valuations are going to be getting stretched in terms of that the promise of the future is what is going to keep the markets buoyant. But the reality is going to take a little bit of time to catch up, and we are going to face that decision in a few months' time.
Are you expecting a reclassification of mid-caps and small
I
caps?
think it's definitely something that SEBI is looking at, and I do hope for a widening of the basket.
How will that change things materially?
So what happens is that if you look at it, right, they've given 150 stocks in the mid-cap space to the fund managers to deploy, right? Now, the 150 stocks, no fund manager goes blindly buys mid-caps. So first of all, there are only 70 odd stocks in the mid-cap index from the mid-cap universe. Right, so 150. So if you're trying to beat the benchmark, you can't ignore a benchmark stock in a mid-cap. Right, because you would like that predictability, because one is absolute performance, one is relative performance. So your focus comes to those 73 stocks, and either you try to buy them or something very similar to them. Second is, every fund manager in the decision-making process doesn't go by large cap, mid cap, small caps. He goes by economy, sector, company. And when he likes that. So even though you may give me money in a mid-cap fund, I'm going to buy mid-cap stocks only in that sector which I think is worth a buy. So then my universe gets compressed, because a sector which is clearly a no buy, I can't buy it though it's there in mid-cap in a significant, like say consumer, for example, or a consumer non-durable.
It's a theme-based approach.
Yeah, because fund managers' research can't be on large caps, mid caps. No, that's too generic. A fund manager researches sectors and stocks.
Sure.
And so you give me money, but I am, like I've seen that mid-cap and small-cap funds in this 9 months have given about 17,000 crores of inflows. Pure large-cap funds only have got 11,000 crores of inflows. ETFs apart, okay, actively managed fund. So when that much money is coming in, and I'm favoring only a certain sector, every fund manager is going and buying that, you're getting that polarization element coming in there. Now in large-cap, chalta hai, because there is still liquidity to get out. But in mid-caps, so I think SEBI, the case has been made to SEBI by various people. SEBI is considering. I do hope when they come and give, the flexibility can be in two forms. Either you widen the basket of mid-cap stocks from 150 to 200, or alternatively, what you do is instead of 65% minimum in that segment, you broaden it a little more, whichever way it works, because it is.
Okay. I have one final question, and that is an obvious one, but I want to hear it from you. If people were present in the dividend option, suffice to move out of that completely because of the budget and get to growth?
So there are two types of things here. So you're talking about the mutual funds dividend options, right? So first things first is that the idea of switching from a dividend option to a growth option of your existing investments is fraught with risk, because there will be a capital gains element. Even a switch of an option from dividend to growth is treated in income tax, you're redeeming. So a tax element comes in on the switch, one. Two is that to the advisor who manages his customer, a person at the lower end of the thing, nothing has changed. Because there's a 10% DDT was there earlier, now there's a 10% TDS, and if he's at a 10% bracket, then it's neutral cases. So the advisor-distributor combination, advisor-customer combination, we'll have to look at this and say, what is my thing? The third thing is, there is an option called an SWP. Now, since the people came in with an idea that I want regular income from my investment, and that's why the dividend options were marketed, you have to simply stop. The fund houses, I would gradually reduce the dividend, keeping the customer's interest in mind, and these people can introduce a systematic withdrawal option. And you see most funds, for example, the regular dividend paying funds already have a 10%, our fund, for example, has a 10% exit load exemption. So up to 10% of your principal you were waived from the exit load.
Got it, sir.
So that is ideally conducive. Up to 10% you can do a systematic withdrawal, and you don't suffer a tax, or if you suffer, it's a 10% on an LTCG or a 15%. So I think there is still ways around of this, but pure coming to a dividend option in the expectation that dividend being your regular income, I think you can write the obituary notice for that.
Okay. On that note, Mr. Subramaniam, take a moment to thank you for joining it today.
Thank you.